¿Qué está pasando realmente en la economía de Estados Unidos y cómo afectará todo esto al mercado inmobiliario en los próximos meses? Hoy tengo el privilegio de conversar con Matthew Gardner, el economista de real estate más reconocido en toda Norteamérica. Graduado de Oxford y del London School of Economics, con él vamos a analizar dónde se dirige la economía, qué podemos esperar de las tasas hipotecarias en lo que queda del año y durante el principio del 2026, y sobre todo qué significa esto para ti, el comprador o inversor internacional en Vail. Acompáñame hoy porque esta conversación te dará una perspectiva que necesitas para tomar decisiones más inteligentes en tu próxima inversión en los Estados Unidos, específicamente en Vail. Hola, soy Beatriz Martinez, la host de este podcast Conquering Vail, donde hablamos de todos los temas relacionados al real estate y al lifestyle de Vail Valley, exclusivamente enfocados al comprador internacional. Bienvenidos a mi podcast. Good morning, Matthew. Thank you so much for being here with us this morning. Finally, we've been talking for the past couple of months, so I really appreciate your time because I know you're a busy person. Tell us a little bit, about you for our audience. I gave them a sort of like an intro, and but I would love for you to introduce yourself. And again, thank you for coming in.
Well, thank you for the invitation, Beatriz. I appreciate it very much. History about me, as you probably gather, not American. I'm actually British. And I've been analyzing real estate both in the UK and the US for, good grief, probably about 28 years. So it's been a long time. I started my professional career back in the UK as a land agent. My company managed estates for the Church of England and actually the royal family. So that's what brought me across to America in the first place, because America didn't get it all back in 1776. The crown kind of kept rather large bits. So that brought me to the East Coast, came out west back in the early 2000s, and that's where I settled. So I'm very passionate about real estate and specifically about the housing market. And my goal has always been to try and give brokers specifically, but also their clients, the information, the tools that they need to be more successful.
No, and I've been listening to your podcast for the past couple of months. I first listened to you on a ninja selling podcast back in the summer, and it was very, very interesting.
Thank you.
Hence why, I thought that this could be a great opportunity for my clients who are mostly from Latin America, from Miami, but international, that invest in Vail. I've been in the market for almost 20 years. And there has been a lot of Latin American influence in the economy of Vail Valley since the late 60s, early 70s. So your insights are going to be of great interest to our audience. And without further ado, and let's begin. I didn't send you this question on my email, but the elections were last night, and I don't know if I want to ask you a question about that, and let's see, if last night New York City elected a new mayor, Mr. Suran Mamdani, and as you mentioned in all of your podcasts, you focus on policy, not on politics. So we're not going to talk about politics this morning, but I'm curious. As we all know, I know it's a city, it's a major of a city, but it's one of the largest cities in the world. And it's the economic hub for the United States and the world as well. So I just wanted your opinion. What do you think would be the economic implications of this particular election? And how you think it's going to impact the real estate market in general? Besides the fact that a lot of people are probably in the process, and again, not to get political, but it's just a fact of looking for more. Florida real estate is about to explode again, I think. But what do you think are the economic implications of this New York City election last night?
Well, I think bigger picture, I can't say I was too surprised. It's actually interesting you mentioned New York. The reason why I say that is that when he won the primary, I happened to be in Lower Manhattan. I was actually giving a speech at the 40 Wall Street building, which is a conversion of an office building into a condominium project. And again, obviously, that was the question I was being asked for about 3 hours, which was, okay, what do you think?
Okay.
again, and thank you for saying it. Yeah, politics. I don't talk politics, but I do
I
talk
know.
policy.
Yes.
And my concern as an economist is that he's mentioning the word free an awful lot. And
Yes.
economists hate that word. And there's a reason why we hate it, because free doesn't exist.
Yeah.
There is always a cost to everything. So when he's saying about affordability, which is, I think, very important from a housing perspective, but talking about rent freezes, further rent control, which of course we know there is already rent control in New
New York
York City,
City. Yeah.
and providing housing for people and free public transit, somebody has to pay. Now, how is that going to work? Well, in essence, if you want to do these things, somebody's going to have to get charged. So the implications, I think, for the luxury in the market, but also businesses, is
Yeah.
that are his policies going to start to push people and companies out
Yeah.
from New York? I mean,
Yep.
we already know that Abbott, the governor of Texas, is saying he wants to put a tax on anyone moving there from New
Moving
York.
to, yeah.
You can't really do that. But anyway, it was an interesting
Yeah.
point. But
Hence, Matthew, why I think they're gonna go to Florida.
well, yeah. I mean, in all seriousness, what we and actually we've seen that
Yes.
really coming
Yeah.
out of COVID. We saw migration out of New York, certainly out of New York State, coming
Hmm.
down the eastern seaboard. Some staying in Georgia, but an awful lot moving into Florida, which was
Yes.
the top five growth states between 2020 and 2024. So yeah, we've already seen that. But my worry is because, as you said, it's the financial hub of America,
Hmm.
and and from a housing perspective, certainly the condo market's really gone nowhere for a number of years now. And it was, I believe, starting to get some traction. Now,
Yes.
is this going to have an impact on that? So I think that is, we have yet to see. But I have concerns, shall we say, about some of
Yeah.
his proposals. Now, proposal to action, a lot of things can happen in between, thinking something and actually enacting it.
Yes.
But
Yeah.
I would say that I'm cautious because of the fact that, again, free doesn't exist. Somebody has got to pay.
Somebody's gonna pay. You're right. Um, but thank you. And again, I don't, you're the expert, but what you're saying, 100% makes sense. I was just in New York City last week. My daughter is a senior in high school, and she's looking to go into colleges. So we were there, all week. A lot of excitement, the New York City Marathon and the elections. But yeah, I mean, yet to see a lot of moving parts, not only in New York City but in other areas of the country. Um, Matthew, big picture, what's your
Hmm.
outlook for Q4 2025 and Q1 of 2026 on inflation, jobs, and growth? And what does that mean for the U.S. housing overall? Both Q4 and maybe, if you can talk a little bit. I know you don't have a crystal ball, none of us
Oh,
do,
I do.
but I think I was going to say, as for all of your podcasts and everything, I think out of everything that I've listened and read, you are the one with the best crystal ball. So that's why you're here.
Oh, that's very kind of you. Okay, wow, a great question to start. And of course, the first thing I'm have to say is I'm having a heck of a time getting data. And I say that because, as we all know, the government is
Government.
shut down.
Yeah.
And because it's shut down, I mean, the last job numbers that I had
Hmm.
were for September. Haven't got October's. I should be getting November's. October's job numbers on Friday, which is Jobs Friday, but we're not going to get it. So we're really kind of working on rather stale information. But
Yeah.
given that, we can still make some assumptions. Now, in terms of jobs, obviously, we've seen a significant slowdown. The last job numbers we did get showed 22,000 jobs added in the US. And that's not
Hmm.
good at all. The unemployment rate notched a bit up to 4.3%. Still a decent number, but
Hmm.
um, my worry is that a lot of companies are now really, and certainly in the tech sector, looking to use AI as an excuse to lay
Yeah.
people off. They
Yeah.
are also uncertain about the future. Now, what do we do as a business owner if we're uncertain? Do we hire more people? No, we don't. We do what's called increasing productivity, and that really means make the existing staff you have work harder.
Okay.
And so we've seen a slowdown there. On on the inflation side, again, now we did have inflation numbers because they had to do them because it goes into what Social Security is going to be in 2026. Now, it's stable, certainly, however, still significantly higher than the 2% target rate that the Federal Reserve wants to see.
Okay.
Now, even though we've seen some stabilization in the cost of goods and energy, service costs are still elevated. Housing is still elevated, and they tend to be what's called sticky, which means they can go up fast, but they tend to be fairly slow coming down.
Come
But
down.
the bottom line is that we are still uncertain about the impact of tariffs. Some
Oh,
had said
yeah.
that we were going to see just inflation skyrocketing in a similar way that we saw back in the 70s and early 80s. That hasn't
Hmm.
happened,
That hasn't
but
happened.
uh, but we're not sure where it's going to go. And in fact, today, when we're recording this, the Supreme Court are actually hearing arguments as to whether tariffs are legal or not. So
Yes.
it's uncertain. So when it comes to taking all these things of lower employment growth,
Mhm.
uncertainty over tariffs, things are costing more. We know that. How does that impact housing? Well, it does in a couple of ways in the macro environment. One is
Mhm.
job security. Are we going to go out and buy a home, which, by the way, for 97% of us in America, the most expensive thing we will ever buy in our lives? Are we going to go out and spend that money if we are uncertain about our job?
Yeah.
Probably not. Are we seeing wages rising at the pace that we saw coming out of COVID? No, we're not. So I think for a lot of people, there's just a certain amount of trepidation, some uncertainty. And I think that is where we're seeing the housing market right now, at least given its relationship to the broader economy. There's lots of other things going on in housing, which I'm sure we will talk about. But that,
Yeah.
in essence, is what I'm seeing right now. And I don't expect to see much change between now and the early part of 2026.
Yeah, and you mentioned something, it's the uncertainty. And that's, I mostly represent buyers and investors. And when there's any type of uncertainty, it just freezes them. I mean, it's hard for them. They much rather, and again, in the market that I work, which is Vail, no one needs to buy a
Hmm?
third, fourth. I mean, all my clients, these are not their second homes, these are their third, fourth homes, vacation homes. No one needs to buy a property in Vail. Period. I mean, unless you live there, but not my clients, and no one needs to sell on my end.
Hmm?
My clients.
Hmm?
So the uncertainty just makes them, wait, just waiting it out.
And I
And
think you're right. Again, and
yeah,
you phrased it absolutely correctly. When we are uncertain, we do what? We freeze in place. We do
yeah,
nothing because we don't want to make a wrong move.
we don't want to make a mistake that's going to
Right.
cost them.
So
Yeah,
therefore, doing nothing, and that's certainly doing nothing is not good for the U.S. economy because the U.S. economy thrives on the fact that we go out spending money.
yeah,
70% of the U.S. economy is consumption, us buying things. And if we're not buying, the economy can't grow.
yeah. You're right. The mortgage path. Let's talk about mortgages. I'm sure that that's the number one question that you get in all of your podcasts and interviews. Where do you expect mortgage rates to be by the end of Q1 of 20? I mean, by the end of Q4, and going into Q1, and what two things could push them meaningfully lower or back up? I mean, we saw that after the Fed's not even the meeting, it was a press conference afterwards. Mortgage rates went back up a little bit. I was already excited that they were at 6.18% or so, I think, the day before, depending on which mortgage, and I don't know what data you have, but now they're back into six and a quarter, correct? And correct me if I'm wrong, you're the expert. um, just let me know what your thoughts are on mortgage rates.
Sure. Well, yeah, you're absolutely right. Again, and some people think it's very counterintuitive when the Fed cuts the Fed funds rate and mortgage rates go up because they see the two as perfectly aligned, and they are not. The
Okay.
Federal Reserve do not control mortgage rates. They have an influence, yes. And the reason why rates notched up a little bit was because of the press conference and Chair Powell saying that he wasn't guaranteeing another rate cut in December, which will be their final meeting of the year. And that's what
Yeah.
led rates to notch a bit higher. To your question as to where they're going to be, I quite frankly am not seeing much in the way of movement from where we are today, meaning that I think we're about 6.3, I think, this morning. That's
Yeah.
probably where I would expect us to be at the end of the year, end of Q1. I'm still seeing above six, probably about 6.2, so about a tenth down from where we are. And there's lots of reasons for this, which I won't go kind of too much into the weeds. But mortgage rates are based on the yield on 10-year treasuries. So you take and that's when the 30-year mortgage was created in April of 1971, what they
Uh-huh.
did is they took the yield on 10-year treasuries, added on a risk premium, because there's always going to be risk associated with a mortgage over a bond, which was
Mm-hmm.
about 1.8%. And that's where mortgage rates were. And the correlations worked out very, very well. So it's really kind of fit within that spread has remained fairly static. Long term, I think that the yield on 10-year treasuries is around 4%. That's going to be its sweet spot, in my opinion,
Mm-hmm.
meaning that you could argue that the long-term rate for a 30-year fixed mortgage is going to be seesawing either side of 6%. Now, I'm not saying it can't go down below that,
Mm-hmm.
but be careful what you wish for. Because if it drops down below that, it likely means we are already in a recession or we're going into a recession.
Mm-hmm.
And I say that because when we see recessions, money comes out of equities, out of the stock market, goes into the safety of bonds. That
Mm-hmm.
pushes the bond price up and the yield, the interest rate down. And so as that drops, obviously then mortgage rates will drop as well. But I think the long-term rate is going to be around 6%, all
Yeah.
being equal.
Yeah. And I agree. And that's what I tell, a lot of my clients. And again, the reason that maybe the buyers are not moving, it's not, my clients mostly, believe it or not, even though, all the properties that I sell in Vail are probably average 2 million plus. I do have a percentage of clients that take advantage. Again, most of them come from Mexico,
Mm.
Spain, Argentina, Puerto Rico, which is not, international, but still. Um, they do take advantage of mortgages, even to purchase properties 5, 6, 7 million. Although I would say maybe 60, 65% of my clients are cash buyers. They still like to see where the interest rates go, and I tell them, again, I agree with you and I listen to you a lot, and other economists. I mean, I don't think, and again, I'm not an economist myself, but I don't. I mean, I'm in the industry that I don't think interest rates are going to change much in the next 12 to 18
Yeah.
months. You
And I,
know,
and I think you're right. But also, I think when you think about the international market, there's a couple of things. One,
yeah,
obviously, if rates drop, then it's advantageous because it makes sense rather than deploying your own capital to buy
yeah,
a home. If you can borrow it at a cheap enough rate, then do that, and then
yes,
take your capital and deploy it elsewhere and spend it on
exactly,
other things which can yield you a greater return. But
exactly,
also, you have to look at it based on the strength of the US dollar. When the US dollar is strong, it makes things more expensive for overseas buyers. When it's weak, as it is today, well, it
yes,
can actually make them cheaper. So I think foreign buyers tend to look at arbitrage, look at the currency markets as well as anything else, because
exactly.
there's a cheaper dollar or a weaker dollar. It can be potentially beneficial for them as well.
Agreed. And I haven't looked at, I don't have my phone on right now. I haven't looked at the Mexican peso exchange, but I believe it was between 17 and 18 the last time I looked a couple of days ago, that for them it's not bad at all. Not
I
only
think,
that, in their countries they're used to 10, 11, 12%, mortgages are not standard there to purchase property. So again, I tell them, and I usually send them the historic of mortgage rates throughout the past 3, 4 decades.
mm,
I mean, again, we're not going to see the 2.5 to 3% that we saw during the pandemic, but and maybe I believe 2019 we were at 5.5, I believe,
yeah,
around 5.5. Maybe that either, but it's not bad when you compare it. If we stay around 6, 6 and a quarter, It's not bad. It's not bad at all when you compare it to the historical data of mortgage.
And yes, I mean, yeah, you're right. I mean, October 1982, mortgage rates were 18%. So, yeah, it's certainly a lot lower than that. But you did bring up a point which I think is worthwhile expanding on just a bit,
Yeah.
because you mentioned in Mexico, and quite frankly, around the globe, America is the only country that I'm aware of that you can borrow money, as in a mortgage, a 30-year fixed
Yes.
rate mortgage with no prepayment penalty.
Yeah.
It doesn't exist anywhere.
Yes.
And that
Mm-hmm.
is one of the amazing things about the US housing market, because if you think about it, less so in the luxury world, but in general, your mortgage payment stays the same. But over time, hopefully, what does your income do? It goes up. Therefore, your share of income you dedicate to a mortgage payment does what? It goes down. So,
Yep.
on the longer term, it's a remarkable financing vehicle, and one that is, quite frankly, unique globally.
And when my clients, I mean, they have their own banks and bankers, etc. But I do a lot of business in Vail with First Bank of Colorado. They offer amazing rates for foreign buyers, foreign clients, and usually what they do is they do the 5-year arm.
Yeah. Okay.
Because by the end of the 5 years, they probably either have paid entirely for 5-year arm, 30-year loan. But usually by 5 years, they've paid, and they do loan to the loan to value is 60-40, 50-50 usually, for the price point in Vail.
Yeah, and
So
I think arms are certainly a very viable option as well. You're absolutely right.
exactly. So I tell them, if you find, because in Vail, and we'll talk a little bit more about that, there's such a
Mm.
lack of inventory. If you find the property that you like and you want, do not wait. Because again, you can refi later on as well. At least with First Bank, you don't have to pay any penalty within a period of time if you refinance. So there are a lot, of options within the offerings that the banks that First Bank offers.
Correct.
um
Yeah. Yes. You're
yeah.
absolutely right.
And I just looked at the peso. It's at 18.59 this morning, which is again not bad. When it's
Right.
lower than 20, for my clients, it's a good exchange,
Right.
for them at least. Um, as we close Q4 2025, where do you expect the 30-year fixed mortgage rate to actually sell into year end? And which drivers will matter most over the next 60 days? The 10-year treasury, the inflation prints, or Fed guidance? What would it take to see a clean break below 6%?
I think at the end of the year, we're probably going to be roughly where we are today. I'm not seeing that much in the way of movement, and certainly not in the next 60 days. I personally think the Fed will cut rates again one more time. That's not going to have a significant impact. So I really think that what we're going to be seeing is going to be is they going to be interested in the bond market. But I think a lot of that's waiting, quite frankly, right
Yeah.
now
Yeah.
on where we are in terms of not the overall government, but in terms of what the economy is looking like. And quite frankly, we don't know
No one
because
knows.
the government being shut down. So
Yeah.
I think really we're going to, I mean, Fed guidance certainly is going to be important. Obviously, I'm very interested to see what the Supreme Court say about tariffs, because there could be very significant implications depending upon what the Supreme Court decides,
Mm-hmm.
if tariffs are legal or not. So I think, yeah, we're really probably we're going to be, we could see it come down a bit. And there's a reason why. I mentioned a bit earlier on that the spread
Mm-hmm.
between mortgage rates and 10-year treasuries has been
Yeah.
used to be stable. Well, now it's about 2.2%. So it's a bit elevated. So what we could see, and the reason for that is that banks are trying to front end a lot of their loans, meaning that they believe that rates will come down, people will refinance, and
Mm-hmm.
therefore they're going to lose that revenue. So they're trying to get as much upfront as they can. So what we could see is that if bond prices may not change, but we could see rates drop if that premium that currently
Mm-hmm.
is being charged above that spread comes down a bit. So yeah,
Mm-hmm.
I mean, could we get into the high fives? It's possible. It's sometime in the early to late spring next year, but I'm still sticking with above 6%, certainly through the winters, but absolutely.
Yeah, fair. I agree with you. Um, from your seat, Matthew, how healthy is foreign national demand for U.S. Residential real estate right now? What are the biggest drivers or frictions, wealth trends, bank lending to non-residents, ownership transparency rules, and how do they filter into second home destinations such as Vail and Miami?
I think that I would suggest for most of the luxury high end buyers and indeed sellers that I've been visiting and talking with,
Yeah.
caution. I think they're cautious.
Hmm.
And that I think applies globally because of certain, obviously, geopolitical tensions that currently exist. So I think that when you're looking at the US luxury market, they're
Hmm.
going to be watching regulation. They're going to be seeing what decisions the administration is making relative to government policy in respect to other countries.
Yeah.
But I think that they are out there, but they're increasingly driven by lifestyle migration,
Yeah.
is certainly, but also wealth protection. So what I mean by that is that
Hmm.
as opposed to being purely driven by capital appreciation, as in the value of that real estate asset going up
Hmm.
significantly, they're looking at where how markets or locations or even asset classes where they can be protecting their wealth. So lifestyle migration is certainly one thing. Diversification, absolutely. We're seeing a lot of that, and that's money coming out of Asia and the
Hmm.
Middle East coming over here. So they're coming in here again because of wealth preservation.
Yeah.
And again, a weaker dollar we talked about is
Yeah.
positive for them. Political instability, and when we talk about that, then I'm thinking about money coming out of countries like China or Russia,
Hmm.
and you'll see outflows into more stable markets. The US is one, London is another, Dubai, Singapore are other markets which will benefit from that. Again, it's harder getting money out of China. It's supposed to be. Than in reality, it isn't. But so outflows coming there, and again, certainly from Russia. And so they're looking about where can they place their money, and,
Yeah.
and U.S. luxury real estate is certainly a, a very viable investment for them. But that's why I'm really thinking in general, quality over quantity,
Hmm.
meaning that I think that's a trend which we've seen for a while. I'm sure you've seen it, and
Yeah.
you're more in the on the ground level than I am.
Yeah.
So fewer deals, but they're more strategic, lifestyle focused, and so wealthy families or family offices, they're looking at that. If a luxury location, but a luxury product as well.
And you know what? Believe it or not, when you talk about lifestyle, it's
Mm.
also safety, for their families. What plan B do I have? There's so much instability right now in the world that they're also looking. I mean, at least a lot of my clients from Mexico, I've had a few that have purchased second homes, and they actually have moved to Vail full time for a couple of years. They have a great community, they love it. And one of the things that they tell me is that the safety that they feel,
Yes.
specifically in Vail, because nothing happens nothing happens in Vail. I mean, I've lived in Puerto Rico, I've lived in New York, I lived in Miami, I've lived in Vail. Nothing happens in Vail. I mean, obviously there's the robbery here and there, but it's such a safe, it's a pure, lifestyle. They have Denver, so if they want to see a play, if they want to go shopping, then they drive the 2 hours. Once you live in Vail, those 2 hours between Denver and Vail become very short, and it's such a fun drive, except when it's there's a snowstorm.
Right.
And
Yes,
they
and you're thinking of it. I mean, I happened to be in Vail last week giving
I
a
know.
speech. So
Yes.
I was at the Four Seasons giving at an event, and I'd never been there before. But as you said, it's a lovely place. I actually
Yes.
flew from Denver into Vail. Um,
Uh-huh.
one of the smallest airports I've ever been to is Vail. But
How was the landing? Did you have fun?
oh, it's one of those wonderful. You kind of go up in the air, be shaken around for 30 minutes, and like a controlled crash landing. And no, it was okay. But no, yeah, and you're right. So I think that, again, if you really, and it's not just from South America, but the
Europe.
Middle East, Europe, I mean, that view of safety is remarkably important. It's a wonderful place in that respect. Obviously, it's got the landscape, remarkably clean. So, and as you said, safe. Those things are important, certainly for
Yes.
families if they're looking
Yeah.
to acquire their fourth, fifth, sixth home when they're not going
And
to be there more than a couple of months a year.
And when you mentioned something that I have never talked about, which is wealth protection, that is very, very interesting. I don't know if you could maybe expand on that. I don't know if when you say wealth protection, it's only the I guess making sure that it's a safe investment, that it's going to appreciate. Or what do you, if you can expand on what wealth protection means for
Sure.
you?
Sure. It's a number of things. And
Okay.
again, if you think about it from a purely monetary perspective,
Monitor. Okay.
so when you look at, let's say, China, and you have a devaluation of the yuan, which we know happens, Russia with the ruble. So these are people, if they're taking money uh, out of their home countries,
Mm-hmm.
again, because of that protection of putting it into an asset, which doesn't need to yield them a 10% annualized return, but
Mm-hmm.
it's not going to drop by 20% either. And
Okay.
again, if you think about it from a real estate perspective, outside of the financial crisis in 2008,
Yeah.
we've rarely seen periods where we've seen annualized year on year declines in home values. And
No.
I'll go back to the 70s. And yeah, we had a period in the 1991 and briefly in 2023 when mortgage rates doubled. But again, we're talking about 1 or 2%. So,
Yeah.
so that's the wealth preservation in that respect. In another respect, it is if they're invested in the equity markets, in the stock markets, whether they be here or around the globe.
Mm-hmm.
Um, my own opinion, again, I'm not a stockbroker. I pay a guy to do that, but I'm looking at the market now, which seems to me to be a bit frothy, getting a bit ahead of itself. So maybe then diversification, taking some money out of equities or some profit out of equities, putting it into something which is more stable. And most importantly, I've yet to see anyone living under a stock certificate. So
I love
shelter
that.
is always needed. So I'd say that wealth protection comes in a couple of forms. One is the preservation based upon on currencies and certain instability in certain other currencies outside of the US dollar. I also see some money coming off the table in terms of money coming out of the stock market
Yeah.
and into a more safe haven. And certainly housing is one of those.
Yeah, you're right. And I don't have the graph, the stat right now, but I'll send it to you. I mean, Land Title Guarantee, which is one of the largest
Mm.
title companies in Colorado. I do a lot of work with them. They have this amazing stat that you can see the growth, the appreciation of the real estate in the Vail Valley since the 1970s up to, I
Oh,
think they
well.
have up until 2024, and
Yeah.
it only goes down a time. In 2008,
Yeah.
no, I own a condo. My family owns a condo in Brickell. I used to live in Key Biscayne as well. I remember it was pitch dark in 2009, 2008, whole Brickell Avenue. That really didn't happen in Vale. I mean, it went down just a little bit, and it went right back up again.
And that's interesting because, I mean, nationally, we actually saw prices drop down between 2007 and 2011. So it was a long period of time.
It was a long period of time.
Yeah.
Yes.
And obviously,
Yes.
Vail, which I can't say I'm surprised, managed to skirt that because Vail is a
Yeah.
very unique market.
Very unique market. You're right. With rates easing but still elevated versus 2021, equity markets are volatile and inventory rising of the lows. How do you see the luxury vertical behaving into winter? Pricing power and time on the market. How do you see the luxury market in the winter?
I think there's a couple of things going on. And what is interesting about the luxury market, whether it's in Vail or actually I'm giving a speech in Miami in January, it's what I find in these markets and in
Yeah.
the US and globally is that you can have buyers and sellers be remarkably patient.
Yeah.
They tend to not be over leveraged, so they're not forced to sell, and neither are they forced to buy. So
Exactly.
I think so. I'd say for the winter, obviously now I know the Vail market does tend to slow down in the winter because of the weather. Uh,
Mm-hmm.
so that is almost it becomes a point of a reset ready to go into next year. But we've already mentioned a couple of things which I think are applicable. One is that diversification, which we've talked about. But I think
Mm-hmm.
for a lot of people, if they're looking to spend what can be a significant amount of money, next year, I believe, is going to give them and the economy a little bit more clarity on what's going
Yeah.
on. We
Yeah.
obviously we went through a lot of elections last night,
Yeah.
so that I think is giving us a bit of an idea of what we might see next year. But when we get into next year, because we have the midterms obviously coming up in November,
November.
that, that a lot of people are now just going to be that watch and wait um, argument that a lot of them are doing right now. I think that they'll probably start making more decisions. So I believe that we will see a more buoyant market in across the board in luxury markets in the spring of next year. So I think that we look at pricing power. Well, again, it's interesting. Yes, you can be have a lot of cash to spend. That's one thing, but a lot of times, as we mentioned, that the seller they are waiting to get what they want. Uh,
Exactly.
at the same time, however, it's going to be incumbent that homes are transacting, you are selling them, and that's because well positioned, well priced housing,
They
whether
sell.
that's at 500,000 or 15 million, is still transacting. The
They're
market still
selling.
exists.
Yes.
But
They're
I
selling.
think it really the case that you've got that. I mentioned the quality over quantity trend that people are waiting. They're not going to get, they don't want things they have to do work on. So if it's accurately priced and it's move in ready, those are selling and that will
Yes.
continue. But
Yes.
I think for people, especially buyers, if they are fence sitting right now, then I think that they're likely to come off the fence in 2026. So I do expect to see a market which is going to see more transactions in 2026 than it saw in 2025, and I honestly believe we'll see more transactions in 2025 than we did in 2024.
And I agree with you in Vail, across the board, but in the luxury, when I talk about luxury market in Vail, it's 5 million plus.
Yeah.
That's the luxury market in Vail. When they are well priced, they sell. And you mentioned something well priced and moving ready. If your home is remodeled, if your property is remodeled and it's well priced, there's a buyer for it. And I think buyers are finally going to come off the fence. I would say maybe in my case, I think from my experience, from my clientele, probably by the end of Q1 of
Mm.
2026, by the spring, when they realize that, as you said, when the election settled, the New Year settled, and once they realize that these, and again, even if they buy cash, they want to wait it out a little bit. Maybe if they're cash buyers, but they are going to realize that these interest rates are not going to, drop significantly. And I think that's when they're going to come off the fence and they're going to maybe probably take advantage of the usual inventory rise that we see in the spring in Vail, to come off the sidelines. That's my prediction, at least for my niche market, which is a very niche market within Vail market, which is a very niche market. But that's how I see it. So Matthew, local supply. How would you read Vail Valley inventory and months of supply for the next quarter? And what signals should international buyers watch to time a smart entry into the Vail market?
I think the supply side, obviously, your market is very unique in as much as it's remarkably seasonal
Yes.
for the obvious reasons. So I
Mhm.
think that right now it's a lot of people were waiting to see whether you were going to see a flood of inventory come into the marketplace. Now,
Mhm.
generally speaking, economics kind of 101 states that if you have too much supply, the prices are going to soften. I'm not seeing that is happening. Again, you will know better, but transactions, I mean, closed sales rose about 17% year on year in September. So
Mm-hmm.
sales were up 21%. Dollar volume was up about just shy of 10%. So
Mm-hmm.
those three things, away from the inventory side, say that that's not a market where you're seeing an oversupply. So,
No.
uh, and I think obviously it's scarcity of land, existing homes. Again, there seems to be demand out there that's driving the market. So I think, but you also have to look at the Vale Valley and break it down even further. And that tends to get into more your world than mine, because
Yeah.
once you start looking too myopically,
Yeah.
that's not a world in which I live. But you've got, I mean, Vale Village is going to be different from Lions Head Village, which is going to be different from East Vale,
Yes.
West Vale,
Yes.
etc., etc.
Yeah.
And we can certainly talk about those. But
Yeah.
um, I think that it's, again, coming into ski season right now. So again, you tell me, is that a market where you tend to find inventory levels going up, or do they tend to come down, or remain static?
They tend to remain static. The inventory rises typically in the spring and in the summer.
Right,
That's usually because, I mean, definitely we see inventory come up in the winter, but the weather factor, the fact that most of these properties are rented. Most
right,
of the properties in Vale Village, in Lions Head, in East Vale, Vale
yeah,
Golf Course, even West Vale, these are all short-term rentals. These are all vacation rentals. So,
yes,
so showing property becomes very, very challenging. Of
yes,
course, that's when we do get a lot of influx of folks that, tourists, and even, property owners, or folks because they come into Vail for skiing, and that's when they decide that they want to buy in Vail. But they usually return if they're very interested. They usually come back for the summer, and that's when I see where we see a lot of these transactions happen. Off season during the summer, and definitely inventory rises. Often during the spring, when the weather, when the rush of the holidays end, when the weather is better. Another thing is during the winter, it's nighttime by 4:30 during most of the months of the winter. So when you buy a property that's 5 million plus, or even 1 or 2, 3 million, you want to see the views. So
yes.
it's very challenging to show property. But that's, but so the inventory, it rose, I believe, maybe, I think it was, I don't know if you have the same numbers, 25 to 30% from last year. But I have seen a decline, not by any stat, just by simply going into the MLS
Right.
twice or three times a day. I have seen that things have sort of like slowed down a little bit, and the opening in Vail is in 10 days, in November 14th. So yeah, I mean, but obviously we get a lot of calls, we get a lot of emails and texts, frantic people whenever, when they're in Vail skiing with their family. That's when that's when they decide they want to buy a property, in Vail. But
Right. And so again, because it said it's not a huge market just geographically in terms of
yes,
listings. Again, I did kind of actually pulled some numbers. Again, you look at Vale Village, 21 homes on the market. That's it right now.
yeah, yeah.
So
Did you see
so
the price per square footage?
yeah,
In
yeah,
some of
exactly.
these
Interesting. I mean,
yeah.
you've got a median list price and sale price, but list price is about 6.3 million, and sale price year to date 6.2. So
Yes.
it's rarefied air, no pun intended,
Yeah.
in that market. So anytime you have very niche markets, then they tend to not necessarily walk to the same beat
Yes.
the drum as the US would, or let's say
Yes.
Colorado or Denver, or really, quite frankly, the Front Range.
Yeah.
So
Yeah.
I think, yeah,
Agreed.
it can be unique. And so I think you're right. I think people will go and make those decisions if they're there skiing. Maybe they'll think, well, homes are on the market still. Maybe there's a reason why, and they're going to wait for maybe some better inventory, more choice to come on the
Yes.
market.
Yes.
Again, goes back to those expectations, because they do want move-in ready homes, chef
Yes.
kitchens, radiant heat floors, ski in,
Yes.
ski out access, these kinds of things.
Yes.
And that's because when you're spending that amount of money, you have
Yes.
certain expectations.
From my experience, when one of the biggest challenges, with buyers, if not, it's the lack of inventory.
Right.
Once there's inventory available, especially in the market that we're at right now, where sellers have to become a little more realistic, I think 100% we're going to get deals done. It's just right now, honestly, it's the lack of inventory. As of 2 days ago, there was only one three-bedroom on the market at
Wow.
Lions Village,
Wow.
at the Landmark, at 6.7, which is, I think it was 3,500 a square foot. I haven't looked at it today. So I mean, that's lack of supply.
Right.
Um, so Matthew, my last final question of the day, because I know you're a busy person. What's your suggested playbook for Q1 for an affluent international buyer with a 5-7 year hold? What are two real opportunities and two key risks you'd highlight in the Vail market? Inventory trends, carrying costs, rental demand, liquidity.
Right. Well, if you think about the buyer pool and who's buying in Vail,
Yeah,
obviously from a domestic standpoint, you are seeing buyers from Texas, Florida, California, New York, obviously. International, nationally, Europe, Canada, Mexico. You're also finding remote professionals. So they're looking to relocate because of flexibility of lifestyle that they have. And finally, those second or third home seekers, but also those legacy investors. And legacy investors tend to be households or family funds where they're looking for multi-generational retreats. So there they're looking at you can bring the family together from all over the world. So that is always remarkable. And at the same time, as you mentioned, the short-term rentals, because Vail's got a very established
yes,
short-term rental regulations, which is
yes,
good because that does give you, and it gives those investors saying, okay, if I'm only going to be there a couple of months, then, and I want to generate some an residual income,
yeah,
well, they're going to look at markets where the transparency that there's a market where an investor can be confident
yeah,
in the short-term rental market. So I think that from a playbook, well, from a home, from a buyer's perspective, then I'd have to say is that uh, as long as we are not going to see a significant growth in overall inventory, and yes, it'll get higher, but again, everything's relative. Still a small market, then you're going to be safe and protected from a value standpoint. I'd say for buyers as well, just to be thoughtful. Don't expect to see double-digit returns on the investment. So don't expect it to be going up by 10% every year
yeah,
because that's just clearly unreasonable.
yeah,
But I definitely see that it's tough to find some negatives, quite frankly. I think that the
yes,
global economy or the US economy would have to completely crater.
yeah,
Don't see that happening. I don't see the equity markets. Yes, could we see a bit of a sell-off? Possibly. I personally, I think we will, but again, that's not my world. So, because again, what do the luxury market buyers? They buy as anyone does when they're feeling wealthy. So if they own their companies and they're seeing their share price continue to go up, then it makes it a bit easier or more comfortable to spend another 5, 10, $15 million on another home. Whereas if we're seeing a significant decline in
mm-hmm.
equity values and therefore the value of their company, they might be more thoughtful. So that is a possibility, but I think it's unlikely. So I think that on the bad side, if we see the only way I could see it would be a significant growth in inventory. Don't see that. Carrying costs, we know, again, they tend to pay cash more than anything else, unless borrowing costs are that reasonable. Rental demand, we know, is there. Um, Negatives, I mean, resale liquidity, possibly. Again, if they are forced to sell and you're selling into a market where there's a lot of inventory, well, then obviously that's going to impact price. But again, I just don't see what the catalyst for that would be.
Yes,
So I think, quite frankly, that as I said earlier, it's not going to be a market that's going uh, just flying and leaping like we've seen certain years in the Vail market and other luxury markets. Miami certainly is one, and New York many years ago.
yeah,
But one that is just going to, I think, continuing to perform because there are very few locations nationally that look like Vail.
Yeah. Oh,
And because of that, and because you're not going to see an infinite amount of supply growth, I think it's a good market without a doubt. And again, different parts and different neighborhoods will be attractive to different markets, to different types of
yes.
people.
Yes.
Some looking for that luxury move in, move out. Some looking to be
Yes.
there longer, more charming, smaller, old town, Bavarian look, that kind of thing.
Yeah.
So I think it gives you a lot of different looks depending on what you are looking for as a
Yes.
buyer.
Yeah.
And so, yeah, no, I think the potential in Vail long term is remarkably positive.
So Matthew, thanks so much for taking the time to come to my podcast and talk to us. Can you let our listeners know how to contact you?
Yeah, sure. Social media, probably the best way, or just quite frankly, Google Matthew Gardner and you'll find me. So that's the easiest way.
And I'll
So,
have everything. I'll have everything on the show notes. By the way, if
okay,
you're listening to this podcast in Spotify, I'll have everything on the show notes. If you're looking at my YouTube channel, I'll have everything in the commentary below. So I'll have all
I'm
your.
terrible. I tend to forget my social. I think M Gardner Econ is my
Don't
Instagram. I
don't
tend to
worry.
forget most.
I'll make sure I'll have it on the show notes. Gracias a todos mis oyentes por su tiempo y no se olviden de suscribirse en mi podcast Conquering Vail, que sale todos los martes o los miércoles, y en mi nuevo YouTube channel que estoy publicando videos todos los jueves del lifestyle, lo que está pasando en Vail generalmente del lifestyle, de restaurantes, etcétera, y también obviamente del real estate market. De hecho, nos vemos solo en 9 días en la apertura de las pistas de Vail. Muchísimas gracias por su tiempo. Hasta luego.